What is going on, everybody? This is S Trades, and this is day 21 of the bootcamp. And in this video, we'll be going over how to recognize market conditions, which is a very important lesson because a lot of people know how to place trades, a lot of people know how to trade, but not a lot of people really know when to be like, all right, today might be a probable day, or tomorrow might not be such a probable day because of this, and that. Different reasons, right? And yeah, so without further ado, let's get straight into the video. So not every single day you're going to be having the most cleanest price action. You're not going to just have, clear uptrend, clear downtrend. There's going to be days where trading on that specific day is going to be improbable, and due to many reasons, right? And this is kind of what the video we're talking about, because you have to be recognizing these certain events, because if you end up kind of trading the improbable condition day, you're going to be getting a lot of stop outs, you're going to be getting a lot of unnecessary losses that could have been avoided easily, right? And it all could be just fixed just by simply recognizing the market conditions, right? So we have 4 market conditions that I personally try to avoid. Starting off with the first one, if we moved up or down over 300 points overnight, right? So if you see that Asia session, London session is pumping or dumping, like due to, I don't know, some sort of news maybe, which we had a few months ago with a lot of the tariff news, right? We've been moving like even thousands of points over market, right? And then the very next morning we just chop, right? So again, before I even actually get into more of these examples, right, you have to understand, right, the market moves in a pattern, right? First, it kind of accumulates, meaning it just kind of ranges, right? It chops around, it consolidates, right? Then it starts to manipulate to certain directions, right? Either up or down, right? And then once it's done manipulating, then that's when we start to distribute, right? Which is the AMD model in ICT, right? And this is kind of not even just ICT alone, but that's just kind of the main concepts of the overall how the trading, how the charts actually move, right? We're not just simply going up or simply going down, right? Whenever we pump up a little bit, like whenever we pump up a lot in one direction, then we usually chop around a little bit, kind of start to manipulate after, and then kind of get our moves again, right? So it's, the market comes in conditions, right? In different stages, you could say, right? So if we, again, are trading super quickly and super fast over market, right? If we're just pumping and dumping like super crazy amounts, like over 300 points, right? Let's say if that happened during London or Asia, right? It's not necessarily that London and New York was going to be like terrible, but most likely you're going to be seeing some sort of chop, right? Because unless there's also news in New York, right? But other than that, like, you can't expect price to just go up infinitely higher, and the pre-market, right, 300 points higher, and then New York opens, and then we just keep on continuing going higher, keep on continuing going down. No, once it starts distributing a lot, then what comes next, it starts to accumulate, right? Because now price has to price found the level that is comfortable at, so price is going to kind of start to accumulate, chop around for a little bit, see what it wants to do, then it might manipulate, and then it's going to distribute once again. This is very important, because I see a lot of people, especially previous few times where this was happen previous times that this was happening, price would literally just dump or pump so much, like literally 300, 400, 500 points, and then we would open in New York, and then we just start chopping around, like up down. There's no clear direction, no, like, price action isn't really clear, and you can't really tell where we're going, and people are still trading that, and then they get a lot of stop outs. It's very improbable, because pre-market just did a lot of its thing, and now it needs to kind of cool off, which is why it's consolidating, right? So that's number one, right? Number two is when we have high impact news in the PM session, specifically FOMC statement and FOMC press conference, right? This is almost guaranteed, like 95% of the times, or 99% of the times even. That's how confident I am in saying this. Whenever there's an FOMC in PM, AM chops. AM would never distribute or never have like such clean price action, because we have very high impact news in the PM session. So pretty much what the market would do, it just kind of chop around, not do a whole lot, just kind of start generating the liquidity on both ends maybe, or generate liquidity on one side just for the news. Once the news hits, that's when the volatility is going to get kicked in, because again, you have to understand, right, the volatility doesn't just come out of nowhere, right? We don't just start pumping or dumping out of nowhere, right? There's a big buyer or a big seller that steps in due to a specific reason, right? Especially if there's news in the PM session, there's a lot of aggressive buyers and sellers that are going to be present in the market due to the news, and due to like Powell speaking about interest rates and all these things that are very important to the market, and the market starts reacting to that. the algorithm or whatever you guys want to call it starts reacting to that, that's when we start moving a lot. That's when we start taking out highs and lows, and that's when we kind of see the cleaner price action, right? But majority of the time, 99% of the time, I've never traded AM session in the FOMC, because the times that I did at the beginning, I've always lost because we just chopped around for the entirety of the AM session. Because again, it wouldn't make sense for price to go ahead and start moving up and down super quickly, a lot of points, because why would there be a reason? If there's news after, in PM session, then why would it do that? It would generate liquidity in order for us to after take it out, after the news drops. So that's pretty much the second one, right? And you guys always check this out, like I mentioned in the previous video. Go on Forex Factory, see your red and orange folder news. If you see FOMC in the PM, trust me, you're gonna save a lot of money. Just stay away from the AM session on that day. If you want, you could trade the PM, after the FOMC happened. Me personally, I don't trade the FOMC day at all, because I've never won it. Like, I don't know how people trade FOMC, because it's just super risky. It's like almost gambling, because price could just shoot up and down easily within seconds, and I never ended up winning an actual FOMC trade in the PM or even in the AM. So I just completely. Third, we have seek and destroy price action, right? So what does that mean? When you see price kind of going nowhere, right? Like pretty much we have Asia, London, New York, our 3 sessions, right? When you see, Asia kind of start to accumulate a little bit, start to taking out lows and then coming back up higher, taking out highs. London opens up, right? We come down again, taking out some lows, right? Then coming back all the way up higher, taking out the highs, and then following to New York, we kind of see the same exact scenario, right? New York kind of goes down a little bit, takes out the London low, and then pumps up back up, taking out the London high, right? So this is pretty much the seek and destroy, right? When you don't see any sort of follow through after taking the main objectives, which are your session liquidity, if you see that the Asia low and high got taken and there's no reaction, and they just simply like liquidity sweeped it, the low, and then came back up higher, and after it came up higher, and then you took out the Asia high, and then it started to come back down lower, taking out that Asia low, and then London came up again, taking out the high, and so on and so forth, right? When you're taking out highs and lows are kind of bouncing between those very important liquidity pools, you're most likely going to again chop once New York opens up, because we don't have any clear sense of direction. We don't have anywhere the price wants to go. We're just kind of taking out the highs, taking out the lows, and then there's no follow through. There's no really a narrative of where you want to go. Like, you can't really be like, all right, we're bullish just because we took out the London low, but yet you also took out the Asia high, and London high got taken and then just dumped right back down, taking out again the London, New York low, so it's very, very confusing to trade that kind of a market where, price is just taking out highs and lows. And also another thing is, right, that a lot of people don't pay attention to, right? Once the daily objective of the session got met, you're most likely also to chop. So in this case, right, majority of the time, my biggest objectives for the session is the session liquidities, right? So the Asia, London, New York highs and lows, and previous day highs, right? Those are usually my main targets. Those are the main objectives that I'm looking for. If I see that we're just kind of chopping around between all of these very important liquidity pools, or if we're taking out Asia high, Asia low, then London came out, taking out London low, London high, New York opened up, London took out the New York, took out London high and London low. We're just taking out all the objectives, and there's no clear narrative. Like, how would you know that, okay, once we took out that high, then we're going to come back down and we're not going to see any follow through, right? People are going to be like, oh, well, let's sell and keep on holding for, I don't know, maybe some sort of weekly low or some maybe fair value gap or anything like that. But how do you know? Because we just keep on taking out highs and lows, right? So it's very improbable to win in these sorts of scenarios, right? A lot of the times this would be like a very break-even day, right? You could, either lose a lot or just get break-even, hit your stop loss. So again, I would avoid this. If you're just seeing, price constantly taking out highs and lows right before New York opens, it's not very probable, because we're just, playing around with our main objective, for the session, right? The previous session highs, previous day's lows and highs, right? If that just keep on getting bounced around, you're not likely to see any kind of follow through, right? And again, all these things that I'm saying is not like 100% guaranteed. Like, yes, sure, you could see that, Asia was kind of playing around, and London took out the Asia high and low, and then New York opened up, took out London high and low, and then it starts kind of moving in one direction. Like, you could also see that. Yes, I'm not saying that it's not possible, but majority of the time, right, you have to just recognize these market conditions, right? Maybe you could see like a clean setup for yourself. I would suggest, even if you do decide to trade and ignore this message, at least size down, because it's not probable. It's not, very highly for you to be winning in these kind of sets of scenarios. But again, there are some traders that, have their strategies tended towards choppiness and like consolidation. So if you're that kind of a trader, go for it. If you like trading and choppiness, that's your field. But majority of the traders are like, they want to see follow through, they want to see momentum and displacements in one or another direction, and then kind of getting continuations or reversals off of that. Not a lot of people like trading consolidations, including myself, right? So I'm kind of just stay out. And finally, for the fourth one is when we have SMT on both sell side and buy side, right? So pretty much, why is that even significant just for us having SMTs on both ends, right? Because if you have SMTs on both ends, meaning like NQ and ES is very, very uncorrelated, right? So if ES is just pumping up higher, taking out highs, and NASDAQ isn't, and NASDAQ is going down, taking out lows, while ES isn't, right? It's very uncorrelated, right? And again, you can't really tell a clean sense of direction, right? Because the thing that you have to realize is NQ and ES, which is the S&P 500 and NASDAQ, are supposed to be moving in tandem. They're supposed to be moving into kind of a very correlated way. Obviously, it's not going to be the same way. Like, they're different in this, in a way of what they hold. But they're the biggest indexes, and they are kind of moving in a very, very similar way. But once you start seeing this kind of a thing, right? If ES came down, taking out some sort of a low, and again, this isn't like a 1 minute or 2 minute or 5 minute SMTs, right? This is like on a high time frame SMTs, right? So, and a lot of times, this is what a lot of people don't realize, right? SMTs, like, yeah, you could look at them on the higher time frames, but if you look at them on a higher time frame, like for example, 15 minute and higher, and if you see like, okay, ES came down, took out previous day low, and then NASDAQ didn't, and NASDAQ came up higher, took out Asia high, and then ES didn't, and then we're just very, very uncorrelated, then it's it's pretty much a confusion, right? You don't really know which direction we want to go, because ES is going one way and NASDAQ is going another way. So we're just kind of be pretty much just, dilling and dallying. Like, you could say, like, we're not really going to get a clean sense of direction. Where are we heading, because we're just pretty much taking our highs and lows and then getting. You wouldn't want to be trading in this kind of a scenario either, because if, let's say, you're longing over here and your final TP is at this high, but then ES takes that high and NASDAQ doesn't, you're pretty much just going to lose out. Maybe you could close on early, but again, that's just hindsight. Like, how would you know? We're just going to keep on getting SMTs, right? So then, boom, NASDAQ comes down, taking out that low, while ES doesn't. And let's say you were trying to short over here, and then boom, you got stopped out again, right? So it's very improbable, and I also stay out of these. Another thing that I forgot to mention, it kind of goes in hand with the news for the PM session, but on Fridays, right, you would have your non-farm payrolls, right? And a lot of the times when you have that news on a Friday, because non-farm payrolls is like a very, very big news, right? And it makes the market become very volatile. A lot of the times on a Thursday, right, the day before, you're not really going to see the most cleanest price action, because again, market is just waiting. Market is just kind of generating liquidity for the actual news to drop, and then that's when it's going to start taking out liquidity. Because so market moves in two ways, like I said in the previous video, right? Market either takes out liquidities, which is the highs and the lows, the important significant liquidity pools, or it rebalances inefficiencies, right? But then why would it start to take out highs and the lows, right? If there's a very, very big news event that is going to drive and fuel the moves, right? It's going to bring in the volatility. So instead, pressure is going to wait and chop around and do a whole lot of nothing, So if you see non-farm payrolls, again, this kind of goes in hand with the news. If you see non-farm payrolls on a Friday, again, Thursday could be a, decently well price action, but from the time that I've seen, Thursday will just chop, right? We won't really have very clean price action again, because the market is waiting on the news for that certain day, right? News, again, play a very, very big role in how you trade, right? Again, if you see, even like, for example, if you have 10 a.m. news, right, you wouldn't really want to take a trade before 10 a.m. because we're not going to really, again, really go into a certain direction, because we might kind of chop around or, manipulate into highs and lows, right? Wait until the news actually drop at 10 a.m. and then we could kind of start to see some sort of a direction, right? So anytime you see news, I would not really suggest trading right before the news, like a few minutes before. If anything, I would just wait until the news actually happen, and then. And again, all of these is just market conditions, meaning like this isn't 100% guaranteed. Like, you could see price, taking out both highs and the lows and still be clean, right? You could also see that market pumping and dumping overnight for 300, 400 points, and then New York opens up and we're still bumping and dumping, like all. But the trading is pretty much a game of probability, right? You have to kind of align yourself with the highest probabilities possible, because if you don't, you're going to be pretty much losing, right? So if any of these things are happening in the market, it is not very probable, and the statistic is not really on your side, because majority of the time, right, it shows and it's been proven that, okay, once any of these things are happening, the session is chopped, right? The session is going to be consolidating. The session is going to be very, very ugly. We're not going to be doing nothing pretty much. We're just going to be chopping around, taking out highs, taking out lows, just jumping around between periods and doing a whole lot of nothing, right? So why would you want to place yourself, and why would you risk money, in a very unprobable market, right? So again, you have to recognize these market conditions. If you see any of these, I would personally stay out, because again, trading is a long-term game. We have to be in this as a longevity. You can't be over here thinking, oh well, today's the last trading day, I'm not going to make any money tomorrow. Like, no, the markets aren't going anywhere. You have plenty of time. The market's going to be open tomorrow, the next month, the next year, unless everything just goes down and the end of the world for the economy, then sure. But other than that, like, other than that, markets are going to be here all day long, every single day. So don't worry, don't FOMO into any of these. Once you start to see any of these conditions, please just stay away. You're going to save your money. You're going to save a lot of stress. I've experienced this, and a lot of actual profitable traders also experienced that. And yeah, this is about it, right? Pretty much simple lesson, right? Very, very important though for you guys to realize these market conditions. If you guys have any questions, comment down below, and I'll be helping you guys out. And I will see you guys